Hi everybody, Howard Friend here. Hope everybody is doing well, doing really well. Enjoying the week so far. We've had some interesting moves, particularly in the yen with the Bank of Japan. The craziness that came out of the meeting, as it seems to do every so often. So some interesting times. We've seen some very interesting moves. So this weekly webinar is again all about one of my own proprietary trading setups, which I've developed over many years of observing market behavior. So it's a price action based setup which has a strategy built around it, which can be used for to attempt to make some profits in the markets on just about any market and any time frame. So without further ado, here we go. So most of you will understand that many of my proprietary trading techniques are built around the theory that most of the big moves that one would like to try to capture when trading tend to occur after a market trap. So I've developed a trading methodology which I call Break and Retrace, which helps me identify when a market trap has formed. So traps tend to form usually when traders find themselves caught on the wrong side of the market. Usually a trap will form after a technical move, for example, the break of a support level or the break of a resistance level, but often they have a fundamental trigger, for example, a news-based move, like yesterday's move on the yen markets. The Bank of Japan saw dollar yen shoot up a few big figures, and that move was completely retraced. So we have a bearish news setup. So as I say, I've developed a trading methodology which I call Break and Retrace to help capitalize on market traps. So this is what Break and Retrace looks like, and I'll just give you the buy example. The sell example, you just turn it on its head, and that gives you the same kind of setup. So the buy setup, the market starts off, whichever market you're looking at, it starts off around a fixed point. We get a break to the downside. Now this fixed point could be the support level if we're talking about a technical trap, or it could just be the price just before a piece of news comes out when it's bearish. So we get a sharp break to the downside. So that's the first part of Break and Retrace. That's the break. Now, what usually happens after the break is you tend to get a bit of a bounce because those that sold on the break or just after the break will start to cover their short positions and take some profits. And then after that rebound, retracement, we tend to get another selling wave. Now, that's the normal course of events after a sharp break to the downside. But what I'm looking for is a situation where after having seen the break, a sharp move to the downside, we get this retrace which goes all the way back up to the point of origin, the origin of the move. And once we get back to, in this case, the blue line, once we get back to this blue line, then that tells me two things. One, it tells me that anybody who sold the market on or after that break are losing money. Once we get back to this point here, we know that all of the sellers under this blue line are short and wrong. They're on the wrong side of the market. And number two, we know that because markets they move really based upon positioning, we know that because there are a lot of people short the market and they're losing money, many of them will want to cover their losing short positions to avoid loss. And that creates the conditions for a market squeeze to the upside because all of those sellers are trapped. They're trapped below this blue line. And they will come into the market, many of them, and they will buy the market, they'll cover their short positions, and that will in turn lead to a powerful rally, a short squeeze rally. Okay, so that's the theory. So this creates a trading opportunity for those that are looking to buy the market, but only once we've seen this move, break to the downside, retrace to the upside. And that sets up the trap, and the buyers come in and the market can fly. Okay, and that brings me to the subject of this webinar, which I call the FBI pattern. So the FBI setup really is a break and retrace type strategy or setup. So what does FBI stand for? It stands for false break of inside bar. Okay, because the inside bar is a well-known pattern amongst technical analysts, chart people, where the market has a narrower trading session. So the inside bar simply is the high of the current bar is less than the high of the previous bar, and the low of the current bar is greater than the low of the previous bar. Okay, so all of the current bar's range is contained inside that of the previous bar's range. Now, these inside bars can be daily bars, they can be weekly bars, they can be 5-minute bars, can be monthly bars, doesn't matter. So it just reflects indecision in the market and a contraction in market volatility. Okay, so that's really the inside bar kind of in a nutshell. Now, technicians look at inside bars, and the theory is that once you break outside of an inside bar, the market tends to see follow through buying or selling. So if the market breaks through the top of an inside bar, the market usually wants to go higher. And similarly, if the market breaks through the bottom of an inside bar, the market will usually go lower. Okay, that's the theory. And many times, I'd say more times than not, this holds true, because a break of an inside bar reflects the resumption of momentum one way or the other. Okay, now what I'm looking for, just going back to the idea about break and retrace and market traps, is if that breakout doesn't really see follow through, then we get people who bought the breakout start to dump their positions because they get they're a bit impatient, and then they start to exit their positions. They get a bit impatient. So if the market then goes all the way back to the other side of that inside bar, then a trap has been confirmed, in my opinion. And then we're talking about a big move in the opposite direction to the original break. So what we've got is a false break of an inside bar pattern. So let's just give you some graphics just to show you what these concepts look like. So here's an inside bar. So the inside bar is simply a bar on which the high is lower than that of the previous bar. Okay, so the market went up but did not break above the previous bar's high. Similarly, on the way down, the market went down and it formed a low above the previous bar's low. So this whole bar is contained within the range of this previous bar. Okay, so now we'll move on to the sell and the buy setup, just to show you how this thing works. So what I've got is the FBI bull trap or sell signal. So a situation where the buyers, the bulls, become trapped and it becomes a sell signal. Okay, so the pattern is often seen at important market tops. The pattern starts with the market seeing a push in the direction of the existing uptrend. That push is followed by a brief pause as people take profits, the buyers take profits, and this correction sees contracting volatility with the range forming an inside range where the lower high and a higher low forms. After the correction, we see the buyers step back in, they take the market through the inside bar's high, but on this occasion, the move isn't sustained and a reversal takes hold. A bull trap is confirmed on the loss of the inside bar's low. Here's the picture. So we start off basically with the market moving higher. Then we get an inside range. The high is lower than the previous bar's high, and the low is greater than the previous bar's low. Now, the bull trap forms when the buyers step in, they buy the break of the inside bar's high, expecting the market to go higher. But what it does instead of going higher is it reverses, because those that bought the breakout, they get a bit frustrated, they exit their long positions, and the market starts to head down. Now, the trap is formed when we break through this green line. So we've had break and retrace. That's where the sell signal kicks in. Break of the high, break of the low, that's it, sell. Okay, simple as that. So let me show you some examples of how the FBI works. Okay, so these are examples. They're on various markets, various time frames. Okay, so what I've done, I'm using TradeStation charting software, which makes life easier when it comes to highlighting whether a bar was an inside bar, an outside bar, key reversal, or whatever it is. So what I've done is on this chart, I've painted the bar pink to denote an inside bar. So notice here that the high is less than the previous bar's high and the low is greater, albeit marginally here, than the previous bar's low. Okay, so there's an inside bar there. Okay, so what happens on the next bar? Now, it doesn't matter which market we're looking at. It doesn't even matter what time frame we're looking at. So what happens on the next bar is the buyers step in, they push the market through the top of the inside bar and even through the recent highs of the range here. But by the end of the session, the market has closed back down inside the inside range. So what happens? The buyer comes in, the buyers come in, they buy the break expecting the market to shoot up, but they're disappointed. And by the end of the session, the market's closed down. So they are losing money. Those that bought the break of this high are losing money. And that's the whole point of this setup. So at the end of this bar, these are daily bars, by the way. So at the end of this day, we know that there are people that came in, bought the market on the breakout, but by the end of the session, they find themselves underwater, losing money. So we know that if the market starts to head lower, there's going to be a lot of people that bought the breakout of this inside range getting out of their losing long positions. And that is what creates the conditions for a move like this. So the trap, as I mentioned, is formed when we break through the other side of the inside range. So we break through the high, we break through the low. That's the sell signal right there. And down it goes. Boom, boom. That is the trading opportunity that I'm talking about. Okay, so it's having the patience to wait for the breakout and then to wait for the reversal, the break and retrace, so that we get through the bottom of the inside pattern and we know that there's a lot of potential for the market to go in the opposite direction. Now, these patterns, setups, they are what I would call short term in that they are good for a couple, maybe 2-3 bars going forward. Okay, they are momentum type plays because don't forget momentum, it turns around very quickly. So we get the market go up for a few bars, down for a few bars, up for a few bars, down for a few bars. So our objective as a trader is to make our money when the market is in a phase which we know is occurring. So we know that when the market breaks through here, the market is in a bearish phase for at least for a couple of bars, and that is our time frame for the trade. Okay. Another thing I will mention before we kind of spend a bit more time on the FBI is another theory that I've got about markets is that they tend to see double thrust, consecutive thrusts before the market turns, and this tends to happen quite a bit as well. So what is a thrust bar? Is when the market closes below the previous bar's low. So what you'll see very often is you'll get 2 of these in a row and then the market turns around. You'll get a lot of that. So I use that as part of my exit strategy. Anyway, let's move on. So this chart here, so we've seen the FBI here, and there are some more inside bars here just to show you what they look like. Okay, and there, by the way, is an FBI on that session there. Break through the high, break through the low, and it goes down for a couple of sessions. Okay, so now we look at some more examples. This one, it might be gold, it might be S&P from way back, I'm not too sure. Again, it doesn't matter. It really doesn't matter what market we're looking at, even what time frame we're looking at. But most of my examples would tend to be using daily charts because I think these setups work better with daily charts. Okay, so what we've got in this situation here is the market. It started off, it was kind of moving higher. It was a bull market, so the buyers were in control. Then we saw a bit of a pullback. Then there was an inside bar, and then the buyers came back in, bought the break of the inside bar's high, expecting probably a resumption of this particular swing, correction, swing to new highs. So they bought the breakout, and the breakout on the close was looking good. So on the close, those that bought the breakout were in the money. But then on the next bar, something happened on the way to heaven. The market gapped significantly lower and then broke through the bottom of the inside bar. So that gave you the FBI sell right there. So there's the inside bar. The buyers come in. They're looking good on the close. But on the next day, the market gaps down, and then the market starts to break through the support level here. And that triggers the start of this bear market. So there is a trading opportunity there as well. Okay, now we get another one. So the market having broken down, it looks pretty bearish now. We get an inside bar, we get another inside bar, and then people come in, they buy the break of these inside bars. It looks like the market's basing, but by the end of this session, the market has reversed intra-session, broken back through the bottom of the inside bar, the last one, and that's the sell right there. Down, down, and down. So you can see another good trading opportunity using FBI there. Moving on, this one looks like a chart of cable. I recognize this chart. It looks like a cable chart from way back when. So it started off with the market kind of forming a bit of a base here. We've got an inside bar at the bottom. The market breaks through the top of the inside bar, but this one really was successful, the breakout. So we broke through the top of the inside bar, closed above it the next bar, and the buyers were in control. That's the normal course of events when the market breaks through the inside bar. Same again here. Market has a nice little double thrust there, looks pretty good. We get an inside bar there, and then the market breaks through the top of the inside bar, resuming the buying. Okay, nice up session there. So again, first one successful, second one successful, and then we get another inside bar, and then up they come again. They buy the break of the inside bar's high, but this time the market cannot continue higher. And by the end of the session, cable has found itself breaking through the bottom of the inside bar and trapping the buyers of that break. Okay, so this is a sell signal right here on the day of a major high for cable. Not a bad place to be thinking about selling cable, purely based upon this FBI setup. So as you can see, the market then starts to collapse, and then we get another inside bar pattern here. Again, this time the market breaks through the bottom of it and continues down. Don't forget the sellers are in control. Swing, correction, inside bar, break, new low. Same again here. The market breaks through. It comes back inside, but we never get back through to the other side of the pattern, and then the sellers come in again. So we have to wait really for the market to get back to the other side of the inside bar. The trap is not complete until we've gone back through the other side of the pink bar in this case. We did it there. We did not do it here. Moving on, another example. This one looks like a yen market, but again, not important what the market is. So what we have here is there's an inside bar there. The market breaks through the bottom, continues down for a bit, then starts to head higher. And you could argue, I guess, that's a bit of a false inside bar breakout there, but it didn't really happen quick enough. I like it to happen within a couple of bars, really, or with maybe 3 bars maximum, 1, 2, 3, for it to be a really good signal. Okay, so the buyers step in, swing, correction, swing, correction, swing. There's an inside bar. The buyers are still in control. The market is trending higher. So after this inside bar, the buyers step back in again, buy the break of the inside bar's high, but by the end of the session, the market closes back down here. So we know there are buyers trapped above this inside bar's high. So this is a sell level here, because we know that when the market breaks up again on the next session, selling comes in. Down it goes again. And this time we break through the bottom of the inside bar, trapping all of these buyers. So all of these buyers on the break of this low are trapped above this high. So now we know there's a situation where the buyers have been trapped above the inside bar's high. The market is likely to head lower, giving us an opportunity to sell as these trap buyers bail out of their losing long positions. And down the market goes. Just coming back on that idea about double thrust again, notice here the market goes thrust, thrust, and it turns. Okay, so that's the what I would call the sell setup where the buyers are trapped. So now I'm going to talk about the reverse, the inverse of that one, and this is the FBI bear trap where the bears have become trapped, and it's actually a buy signal. Okay, so this pattern is often seen at important market bottoms. It starts off with the market in bear mode, where the market sees a push in the direction of the existing downtrend. This push to new lows is followed by a brief pause as the sellers, short sellers, take profits. This correction sees contracting volatility with the range forming a lower high and a higher low. In other words, an inside bar. So we've got a formation of an inside bar within a downtrend. So after this correction, we get the sellers step back in, they push the market down through the bottom of the inside bar, and they make a new low, sometimes a new trend low, sometimes just the break of the inside bar. But this move isn't sustained, and we get an upside reversal because those that sold the break of the inside bar are not very happy. They're on the wrong side of the market. They cover their short positions, and this drives the market higher. The trap is confirmed when we find ourselves through the other side of that inside bar's high. And here's the graphical example of what I'm talking about. So we start off in bear mode where the market is headed down. We then get a pause for breath, and the market sees a sideways session, makes a higher low and a lower high, an inside bar, and that creates the conditions for the market to maybe have another push to the downside, and then we start to look at what happens after that. So in this case, the market breaks through the bottom of the inside pattern, but there is not enough momentum to carry this market down. Normally what would happen is we would expect the market to be down here, to extend its decline down here. Swing, correction, swing, like that. That's the expectation when we break through the bottom of an inside bar within a bear market. And that is what usually happens. But as I say, with this break and retrace market trap idea, I'm looking for the situation where it doesn't happen. So when it doesn't happen, we know there's a lot of people that are disappointed and they will be ready to buy the market. So again, once we get back to the other side of the inside bars pattern, this green line, we know that all of these sellers are trapped below the green line, and they will create the conditions for the market to likely push higher. And that is where our trading opportunity comes from. Let's see some examples. Okay, so first up, we have a market which is trending down. So swing, correction, inside bar within a bearish sequence. We expect the market to break through the bottom and to continue down, which is what it does. So the market breaks through the inside bar's low, and we get this big down session. So not a bad thing to do, selling the break of the inside bar. Certainly not on this day. Then we get another inside bar, and they look at the last one and they think that's what happened last time, so we'll sell the break of it. And the market breaks through the bottom of the inside bar's pattern, and it even breaks through the bottom of the swing low that makes a new low for the whole trend. But something happens on the way to heaven, and by the end of the session, the day, the market finds itself closing all the way back up here. So imagine if you'd have sold the break of this inside bar. The market breaks down, it's looking good, but by the end of the day, the market has rallied all the way back up here. And suddenly you find yourself underwater, you're losing money. And again, that's what puts the market into a vulnerable situation, which means that the path of least resistance is now not down, but up. So the path of least resistance has switched from down to up. And that, my friends, as a trader, that's what you're looking for. You're looking for what is the path of least resistance? What's the most likely course of the next couple of bars? If it's days, what's the course of the next couple of days? So on this next day, the market then breaks through the top of the inside bar, and that confirms that the trap has been sprung. All of these people here are losing money, and they will be buying in the market, covering their short positions, driving the market higher. And there again is that opportunity. This is the opportunity that I'm talking about. Break to the downside, retrace to the upside, buy, and you take your profits as the market goes higher just for the next couple of bars. That's enough, 2, maybe 3 bars. That's enough for you to make some money from the momentum of the market. Now, again, remember what I was saying about double thrust. Here's that double thrust situation. Close above previous high, close above previous high, time for the market to turn. That happens quite a bit. Okay, so that's that opportunity there. Another one. So this market looks like an Aussie or a Kiwi, probably Aussie. So the market starts off heading down, forming a bit of a low. There's a retest of the low, and then the market goes into a an inside pattern. So it looks like a bearish consolidation pattern to most people, to most technicians. So the logical thing would be to sell the break of the inside bar. So these guys come in, they sell the break of the inside bar, but it just goes through maybe by a couple of pips, not a whole lot, but enough to trigger the trap, okay, or the first part of the trap. So the market breaks through the inside bar. They're expecting the market to be down here somewhere, but it's not. By the end of the session, guess what? The market has retraced all the way back up here. So imagine if you'd have sold the breakout of this bar, expecting the market to do this, to head down, but it didn't. That's the point. It didn't. So they're disappointed. So that puts the market in a very fragile situation in terms of going up. And when we get back through the top of the inside pattern here, that's the trigger. That's the buy trigger. Break and retrace, and up you go, just like that. Good opportunity right there. Okay, moving on, another one. So this one starts off with the market in a very powerful session, a strong session, very powerful session. Everyone in the world is bullish at this point. Okay, you can't imagine many bears left in the market, at least on the short term, after a move like this. We get an inside session as some people, I guess, take profits and new buyers come in, and then we get the break through the top of the inside bar right there. Look at it, it's just marginally above this previous high. And that's the whole point. They've come in expecting another one of these. Swing, correction, swing. That's the expectation. But it doesn't always happen. As Mick Jagger once said, you can't always get what you want. So the market breaks through the top of this bar, but by the end of the session finds itself way back down. So we know at the end of this bar that these guys or girls or both are trapped above this high. They're trapped. So which means that should we get back through the bottom of this inside bar, the market is likely to go much lower. And just kind of digressing a little bit, I think the reason why this works is because people who bought the break of the inside bar, they tend to put their stop losses on the other side of it. That's usually what technical traders do. If they buy the break of a high, they put the stop on the other side of it usually. So we know that if the market breaks through this point, stop loss orders will be hitting the market, and that is what helps to trigger this big move to the downside. So again, break to the upside, retrace to the downside, down it goes, and that's a double thrust right there. Close under low, close under low. Double thrust, take your profits. Okay, so having seen this double thrust and the market then do an inside session, it looks bearish. The market breaks down through the bottom of the inside session and it continues to go down. At this point, it looks bearish as hell, but by the end of this session, the market has rallied all the way back up to the top, towards the top of the inside session. So we know that all these sellers are now losing money at the end of the session. So the market is vulnerable to go in the opposite direction. Next bar, the market breaks up through the top of the inside pattern, and that springs the trap, and that is the start of a major bull market for this. Looks like a yen rate. Up it goes. Okay, another example here. So this one starts off with the market kind of chopping around. So up, down, there's an inside session. The market breaks through the top of the inside session, but by the end of the session, the market is broken through the bottom. So we've got what I might want to call for a future webinar, inside out. So we have an inside pattern followed by an outside pattern. So inside, out. And then the market breaks down. So there's a sell opportunity right there for the next couple of bars, which gives you a bit of an opportunity there to attack the market on intraday there and then holding for the next bar. Okay, so then the market bases, has another crack at the lows. We get an inside bar, and then the market breaks through the bottom of the inside bar. And again, we get another inside out like this one. So the market breaks through the bottom of the inside bar, but by the end of the session, it's up through the top of the inside bar. So those that sold the break of the bottom will be bailing out on the break of the top. And this is the start of a major swing to the upside for this market. Up it goes like a rocket. Okay, moving on. I think I've lost the scale there, so I'm not too sure which market it is, but again, not that important. So the market starts off trending down, so the bears are in control of the market, like that. Nice move to the downside. Then we get an inside session here. So usually the inside session is a continuation pattern. So people sell the break of the inside bars low, and down it goes. So it's looking pretty bearish. So if you'd sold the break of this point here, if you are bailing out as the market's breaking down, you're making money. But if you're not, if you're holding this market, this position until the end of the session, the market has come all the way back up through the top. And that is another inside out pattern. Really not a good place to be holding a short position. So that springs the trap. We've broken through the bottom of the inside pattern. And then on the same bar, we've broken through the top. There's the buy. And up it goes, boom, boom. So there's that double thrust I mentioned before. Close above previous bar's high, close above previous bar's high, 2 of those in a row, the market often turns the other way. And just out of interest, close under previous low, close under previous low, turn. Same again here, close above previous high, close above previous high, then the market starts to see corrective action. Okay, more examples on the same chart. So at this point, the market really is ramping higher. It's broken through this point here, so it looks like a double bottom, and then the buyers are in control. Great. Pullback, swing, pullback. And then we get a break through the top of this inside bar, which looks bullish because the trend so far has been up. Break through the top of the inside bar, but on the next bar, we get the slam down like that. On the next bar, the market sees a big reversal, breaking through the bottom of this inside bar pattern, trapping all of these buyers. They're all trapped above the inside bar's high. And then the market starts to break down, 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 down. Then we get another one at the bottom, inside bar, another break through the bottom. People sell the break of this point. Then on the next bar, the trap is sprung, the buyers come in here, and up it goes like a rocket. Okay, so that's pretty much how the setup works. So before I outline a couple of strategies based upon the setup, just want to talk a little bit about market orders, because it's quite important when you're actually trading, just to know a little bit about how to enter and how to exit the market. So 2 of them, stop orders and limit orders, I'm sure most people are quite familiar with, but I'll just quickly cover them. And also I'll be covering what I call time-based exits. And I find those really, really good for getting you out of the market before momentum can go against you. So stop orders, a sell stop order is an order to sell below the current price. So what you're doing is you are selling into weakness. Sell low, exit short, even lower. And these are used for entering short positions and exiting long positions. A buy stop order is an order to buy above the current price. You're buying into strength, buy high, exit long, even higher. And these are used for entering long positions and exiting short positions. Okay. Now, most people know what stop orders are. Limit orders are kind of the reverse of that. So a sell limit order is an order to sell above the current market price. So what you're doing is you are selling into strength. A buy limit order is an order to buy below the current market price. So what you're doing is you are buying into weakness. Now, I only use limit orders for taking profits for my PT levels. I don't enter trades using limit orders. I enter trades using stop orders. Okay. Now we move on to the interesting one, the time-based exit. So what is a time-based exit? So time exits are used to get me out of a trade after a certain time period has gone by. So an example of this would be, okay, I'm long the market, get me out after 3 days. I'm long the market, get me out after 2 hours, that kind of thing. And the reason that I do this is because I'm well aware that market momentum is very fickle. As I showed you at the very start, momentum will swing in both directions very, very quickly. So you'll see a few bars up, a few bars down, maybe a few bars sideways, and that kind of thing. So if you're in a trade, the idea would be to exit your trade before momentum can turn against you. So what I'm doing really is I'm looking to get out of a winning trade, hopefully, before the market can reverse. So I use my time-based exit for reducing risk. Okay, let's take a look at the buy setup. So here's the buy setup for FBI. So how does the buy setup work? First of all, we need to wait for the market to form an inside bar, where the high is below the previous bar's high and the low is above the previous bar's low. Then we wait for the sellers to step in and to break the low of that inside bar. I say usually within 3 bars because I want this thing to happen fairly quickly. Okay. Then if we get that, then I place a buy stop for 3 units at the inside bar's high. So I know that if, having broken through the bottom of the inside bar, we subsequently move through the top of the inside bar, then I'm going to automatically buy the market. Okay. So I'm ready. I'm basically ready for that trap. Also, we need to know that because these setups, these signals, they're not going to be right all the time. Most signals are right maybe 50 to 60% of the time, really, if you're going to be honest about it. In fact, if you're a trend follower, most of your great signals where you make your money are right maybe 40% of the time. So we need to be a bit honest about whether we're going to be right every time we trade, and we're not going to be right. We're going to be wrong quite a lot of the time. So to countenance this, what we need to do is use a protective stop. And in this case, I place it below the low of the inside bar, because we know that if we break through the top of the inside bar, we go long. If that market goes back through the bottom of the inside bar, there's something wrong. There's something wrong with that particular trade. So we want to be out, simple as that. Okay, that's the downside. This is how we manage our risk. Now, what about if the market goes as we expect it to go in our favor, to the upside? So this is where the limit orders come in. So we calculate PT1 and PT2. These are levels where I'll be banking a third of my profits at one price, PT1, and at another price higher, PT2. So we know where we're going to get out if we're wrong, and we know where we're going to get out if we're right. And the time exit, that comes in to get me out after a certain time period has gone by. Okay, so this is what the trade looks like. So the market breaks through the bottom of that inside bar's pattern, and then subsequently breaks through the top of that inside bar's pattern. This is where I buy my 3 units. So I'm long 3 units. Where do I put my stop loss? Usually below the low of the inside bar. Sometimes we could even use the low of the swing. That's another way to do it as well. Okay. Now, then we calculate our profit targets PT1 and PT2. So if the market doesn't stop us out and it goes in our direction, we hit PT1, we sell one of those units. So now we're long 2 units. The stop loss can be moved up from the risk level right here to the entry price right here. So if the market subsequently eases back to our entry price, we simply get out of what we've got, the remaining 2 units. But if the market continues to go higher, hitting our second target, PT2, the limit order is triggered and we get out of another unit. Great. Then we can raise the stop to PT1 so that if the market then reverses, comes back down to PT1, we get out of the last unit and say, thanks very much. We've had a profitable trade, and then we move on. But if the market continues to go higher or even a little bit lower, doesn't hit PT1, we just get out on the time-based exit. We say, thanks very much, enough time has elapsed, and we're out. That's it, move on, next trade. Now, flipping it over, what works on the upside should work on the downside. This is the FBI sell. So first things first, we need to see an inside bar pattern. Okay, that's the first thing. Then we wait for the market to break above the inside bar's high. Again, usually within 3 bars. Then we can place a sell stop at the low, just below the low of that inside bar, so that if the market then breaks down through the low of the inside bar, we find ourselves short 3 units. If we're short 3 units, we need to protect ourselves with a buy stop to get us out, to stop to cut down the loss if the market goes the other way. Usually I'll put it above the high of the inside bar. Again, it can be above the swing high, which is a bit higher. We hold our short position for PT1 and PT2 where we place limit orders, and we have a time-based exit to get us out no matter what after so much time has gone by. Okay, so these are the parameters of our trade. And here is the graphical representation. So what we've got is the market breaking through the top of the inside bar and then subsequently coming back through the bottom of the inside bar, the green line here. This is where we short our 3 units. So we short 3 units, we put our protective stop in, so if the market then goes the other way, we take a small loss and then we move on. But if the market does as we expect it to do, we will be taking our partial profits at PT1. We buy back one of those 3 units at PT1, then we can lower the stop from the risk level to the entry point. Great. If the market then bounces from PT1 to entry, then we get out of the remaining 2 units, but we still made a profit. It's okay. But if the market then continues to go down, hitting PT2, we buy back another unit, and then we can lower that stop to PT1. Again, if we bounce from PT2 to PT1, we simply get out of that last unit in a profit, still in a profit. But if the market then doesn't do that, it goes sideways or goes lower, whatever it does, as long as it doesn't hit PT1 and that time exit kicks in, we come in and we say, no matter what, thank you very much. Great trade. Let's wait for the next one. We move on. Okay. Okay. So that pretty much summarizes the setup. I hope it makes sense to everybody. And I hope the strategy makes sense, because what I've done is I've given you some pretty clear parameters for entry and exit based on a very simple setup, which has a very strong kind of underlying rationale behind it. It's always good when you're trading to know exactly why you're trading. Why am I buying? Why am I selling? You know, you have to know exactly why you're doing what you're doing. And this setup really gives you a clear, some clear parameters which you can use. So to summarize, FBI patterns often form during strong trends, whether they be uptrends or whether they be downtrends. They often provide an early warning that a new trend could have started. So the examples I've shown you, many of those examples, that inside bar pattern forms just before the market makes a major high or a major low. So identifying the FBI at the top of an uptrend or at the bottom of a downtrend can get you in very, very early into a new trend. If that's what you, if you happen to be a contrarian trader, using the FBI can be quite a good entry into a trade, in my opinion. So the FBI setup provides clear reference points for trading and for calculating your risk. So you know where the risk level is going to be. You know where your stop should be. So then you can say, okay, well, if my stop is there and it gets hit, how much am I going to lose? Well, that will depend on the size that you trade. So it gives you some clear reference points. Also, something I'll add as well is that the FBI, it can give you, if you happen to be a contrarian trader, many contrarian traders, they go in and they say, well, okay, I'm a contrarian trader. I'm going to buy the market just because the RSI is below 30 or just because the stochastic is below 20. And that can be a good strategy sometimes, but very often it's a bad strategy because it usually tells you that the market wants to go lower. Now, without a reference point to say the market has stopped falling, for example, if we're looking to buy the market, you can be holding long just because the market's oversold and the market continues to go down and down and down. And you don't want to be doing that. You really don't want to be doing that. So this gives you a clear reference point to get into the market, a reason to buy the market. Okay. Lastly, I'll say the FBI setup is valid on just about all time frames and markets. I've shown you examples with many different markets, different time frames, mainly daily, but obviously there are some longer time frames there. It does work on intraday as well. Believe it or not, you can use this stuff on hourly charts and even 5-minute charts or whatever it is you use. But I will always put in a bit of a disclaimer here, is that I don't think any pattern that you use, whether it's a candlestick pattern or one of these things, it doesn't work quite as well on these intraday charts, purely because the intraday charts are much more volatile and you'll get a lot of fake signals on the intraday charts. Okay, so that's pretty much where we are there. Before I close this off, I'm going to say, as I often do, a few words on money management. Now, what I've shown you is a discretionary trading strategy. Okay, it's not a black box. It's not a systematic trading strategy with a back test report you can look at with statistics like maximum drawdown and consecutive winners and losers and all that kind of stuff. You can't do an equity curve based upon this unless you program it and you actually calculate the all of the levels. So when you're dealing with something which is a bit subjective, this is a subjective methodology to a certain degree, in that you don't know that how many of them are going to happen and all the rest of it. So when you use a subjective or slightly semi-systematic methodology like this, it's always good to get a firm grip on your risk management. Okay, so what I tend to say to people is keep your trade risk constant as a percentage of your open equity. Okay, so don't keep changing the size of your trades, not by a significant amount. Don't trade one lot on one trade and suddenly trade 3 lots on the next. It doesn't make sense. It really doesn't make sense. It's not a good idea. It's akin to gambling. Try and keep your trading sizes relatively constant. Okay. Also keep your risk small as a percentage of your account. So I say, for example, here's a common one that people use. Don't risk more than 2% of your account on any one trade. Now, everybody's got a different number. Some people are happy with 2. Some people are even happy with numbers above 2%. I know some of these people. I've traded for them. It's not my recommendation because the swings can be quite big. But many people are happy maybe with, I don't know, 0.5% or something, 0.25% on any one trade. But it's good to have a number that is good for you, that you're comfortable with, that will not blow your account if you get a few trades wrong. Okay, always be cognizant of you could be wrong on the trade. You could be wrong. Your next trade could be a loser. Your next 3 trades could be losers. So you need to think, well, okay, what if my next 3 trades are losers? How much am I going to lose before I start to make money? Okay. Even the best traders and strategies and algos, or whatever you want to call them, expert advisors, will suffer drawdown periods. Okay, most people don't really understand what is a drawdown. What is a drawdown? A drawdown is a series of losing trades, not necessarily consecutive. We're not just talking about 3 consecutive losing trades. We might be talking about win, lose, 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 win, win, lose, win, lose, lose, lose. A series of trades which result in a loss of equity. So whatever you do when you're trading, you need to allow for these drawdown periods to occur. And that's where knowing what your risk is on any one trade can be a very good idea. Okay, before I close, I'm going to say on this subject, because this is all about market traps, and they're very good, in my opinion, very good opportunities to trade the market. Don't anticipate the completion of a trap. Wait for it to form. So on our example with the FBI, don't enter long before the market breaks through the top of the inside bar's high, having broken through the low. Wait for the market to break through the top of the inside bar's pattern, because I've shown you a couple of examples where the market nearly does it, doesn't do it, and then just continues its trend. So be patient, wait for the traps to form, get the examples, look at a load of markets that you like to trade, and then just print the charts out, have them ready, identify the inside bars, and then wait for break of the bottom, break of the top, break of the top, break of the bottom, and then you know exactly where you are. Okay, I'm going to close it off right now. Thank you very much for attending. It's been a pleasure, as always, to present to you on some of my own trading strategies, my own proprietary trading strategies. Just to let you know, if you've got any questions on any of this stuff, you can always reach out to me on LinkedIn. Always very happy to answer any questions on any of the content from this. Alternatively, you can chat to your CFI representative. They're always very happy to pass on any questions that you have to me. And just one more thing to say is that apart from doing these webinars, I run a subscription service, a systematic trading service for day traders on foreign exchange. So if that kind of thing, if you could do with any help in terms of market timing, or if you need any direct one-to-one education, reach out to me. That will be great. I'm sure I can help you. So thanks very much, and same time next week. Have a good one. Cheers. Bye-bye.